We all know that the Bank of Canada has paused rates. They are the first major world federal bank that has paused rates, and they have taken a different path compared to all the other countries of the world. We have a report that the Bank of Canada puts out, and it's their decision and their thought process into what their thoughts were to do that. We have to look into that so that we can read into what's going to happen into our future so we can make better financial decisions for you and your family. That's what we're going to be doing today. So let's just jump in right away into this article, the summary of governing council deliberations for March 8th when this came out. So this takes some time usually for it to come out. Let's take a look a little bit about what they were talking about. Now, this account is of the deliberations by the Bank of Canada's meeting that they had on March 8th, like it states there for you. So a couple notes that I wanted to show. It's pointing out the international economy. They're saying that the GDP of the country, gross domestic product, was slowing in all regions except Japan. We're going to be taking a look at that because our GDP, even though they're saying it's slowing overall, of course, this is back in 2000, you can see a general trend upward. But even if we look at before the shutdowns in 2018 and 19, we are significantly higher. Let's continue though. Global prices were evolving in line with the bank's expectations. Not sure if they actually knew what was going to happen, but that's another story. All right, so global growth has been slowing. We know that. Labor markets are still tight, especially in the United States and Europe. I want you to notice, please, how many times they bring up United States. They bring up United States over and over and over again. And this is why I always say we have to pay attention to what is happening with the world reserve currency, which is US. And you also have to pay attention to your number one trading partner, which is, in our case, I'm in Canada, the US. So two reasons for you to do so. And this is exactly what they're doing. That labor markets are tight, especially in the US and Europe. Unemployment in the euro area remains at a record low, and the United States. The ratio of job vacancies to unemployed people was high. Wage growth was strong. Was it strong? It was only 4 to 5%. Elevated core inflation in the United States and Europe were persistent. Well, we knew that. And the United States lower core goods inflation was offset by higher inflation in core services. We also knew that. So members of the governing council discussed whether the resilience to the U.S. economy to higher interest rates and the persistence of elevated core inflation foreshadowed similar developments in Canada. So, they have to. I always tell you that it's normally 92 to 96% of the time or something like that, that Canada will follow whatever the United States does. So we have to always be paying attention to that, okay? Because it's normally the United States does it and Canada follows. So here's the funny thing. Canada has high inflation, US has high inflation. Canada has high employment, and US has high employment. So they have kind of both. Those are the two things that they look at. They're both in serious trouble on both sides, but Canada goes, well, we are going to pause, and the US says we're going to continue to raise rates. So it's funny. It's funny. Exact same situation, completely different outcome. Okay. We're taking different roads, which I find very interesting. The economy was flat in the fourth quarter of 2022 and real GDP growth at 0%. So I want you to remember this, okay? Real GDP growth at 0%, even though it depends how you look at it, right? Wage gains have remained in the 4 to 5%. This is the same in Canada and the United States, those same numbers. But this is what I ask you. If inflation is actually sitting around like 10% and you have 5% wage growth, you're not winning. You're still behind by 5%. Behind that 8 ball. All right. Now they pause those rates, right? We all know that. Most of the slowdown, it said, resulted from, please note, lower energy prices, of which they have no control of that. That is the OPEC plus. So it's not within Canada's control to lower that. So they can't pat themselves on the back too much for that one. Also continued easing inflation for durable goods. Well, that's because they raised the interest rates, and lower prices for some services, notice, but it's mainly mobile phone service. That's all it is. Mobile phone service. That's not something to be proud of. Okay, food price inflation is the next one. We all know that double-digit rate gains. Now, the governing council members acknowledge that high rates of inflation of essential items such as groceries and shelter costs are particularly painful to low-income Canadians. Okay, so number one, this goes back to our same law that we tell everybody all the time, is that the things that people need will go up in price. The things that people want will come down. You must have eggs and wheat and, like flour or milk, your base food that you need. I'm not talking about buying caviar and lobster tails. I'm talking about basic food always will have that demand. And so the prices will go up. Also, that basic shelter will also always go up. But it's the fun things in life. Your 8-bedroom, 17-bathroom chateau, that's going to go down a lot, like 50%. And fancy boats and cottages and all that other fun stuff, that's going to go down. So they acknowledge that. But this is the funny thing. When you just say, we acknowledge that it's hard on middle class and poor people. I know, but how does that help you? How does it help you by acknowledging? It's like when somebody says thoughts and prayers. I know, but I could really use like some grocery money, What can you do? And this is where it's hurting. So imagine that you have a family who's working tirelessly and they could barely afford rent. They can only afford the basic food like rice and beans, and their kids can't get any new clothes and you can't get your teeth fixed or anything else. Okay. If you're in that type of situation and then the government says, well, the answer here is to raise the prices by 20%. That's going to help you. It's hard for those people at the bottom who cannot get by to understand that if you just raise the prices 20%, that's going to help me feed my family more. I don't know how we sell that. It's really, really tough. And it says, so the results of the slowdown was because of lower energy prices, which we already talked about was the oil producing countries, easing of inflation on durable goods. That's because the interest rate went up, and lower prices for cell phone services. This is one of my favorite topics, you guys, because the prices of phones are not going down. Prices of phones go straight up. Okay. Also, the prices of your plans are going straight up. But what they do is they say, well, we take the number of gigs in your phone of data storage and divide it by the purchase price. That's how we see that the price is going down. Or they're going to do some other math. Well, I know that your plan went from $50 to $100, but you get more gigs for it. And so the way that they measure it, more gig for more money, and they do the division, and now it looks like those prices are going down. But nominally, it's not going down. All right, so considerations for monetary policy. They're very concerned about the risk that inflation could get stuck above 2% target, which I believe is absolutely the way it's going to go. You guys know that I'm expecting 10% inflation for 5 years in a row. And whether they're going to report it or not, I don't think that they will. They don't usually. So I think that you have to, in real terms, see high inflation for several years to come. So continue to prepare for it. And notice it says it will require a better balance between demand and supply. Now, we always come back to that. This is economics 101, where demand has to meet supply. So the only two ways for the market to come into balance is if everybody needs more corn, okay? Everyone's eating corn. We need more corn. So if everyone's rushing to buy this amount of corn, the price will go up and up and up and up. So how do you balance out? You can either grow a lot more corn and then it will keep the price even, or you have to raise the price of corn to like $100, for one corn cob. And then when the price is so high, people will just go, forget it. And so that's the path that we've chosen now. Here's the reason. It's very easy for us just to raise the interest rate. Very easy for you to raise the interest rate. Everyone's going to slow their spending down really, really quickly. And the government makes a bunch more cash. But the hard part would be, okay, a lot of people are eating corn. We got to get a lot more land, clear it, fertilizer. We got to find people to run it. We need farm equipment. It'll take a couple seasons to prepare everything. That's a long path. It's a lot harder to work on the supply. So I understand why people want to go to crush the demand part by raising interest rates to the moon. But I'm a supply guy. Why don't we get more corn if people like eating corn? You know what I mean? Or whatever it is. Policy decision. Now, they say there to continue their current policy of shrinking the balance sheet by allowing maturing bonds to roll off. They're going to continue to shrink their balance sheet, the same as in the US. If accumulated evidence were to suggest that more inflation was here, the policy rate would rise farther. And so you guys, you can go and check this out if you want, right on the Bank of Canada's main website. If I click on it, you'll see that they have their policy rate at 4.5%. We just talked about the US now is up to 5. Our CPI inflation is here. Their reported inflation is even higher than their policy rate. So they're guaranteeing that if you invest money in some kind of GIC or treasury bill, you will lose even by their own inflation numbers. And here, this is their latest news that you can go look up their summary. They do this after they have put out their rates. So we know if we look in the states now have raised their rates. The states now have put it to 5%. Which is quite high. If we look down, it looks very, very similar to Canada, where it was high. The great financial crisis dropped it to the floor. They started raising it, and right into 2019, in the fall of 2019 is when the repo market collapsed. And so the banking problems were very, very evident even before the shutdowns happened. Now, they kept it very low for too long, fueled a massive bubble, and now we're paying the price. Now the bill has to be paid. So now remember before we were talking about there is a difference between United States and Canada Canada, we have kind of the same information, and we've both chosen different ways to deal with it. So the United States is continuing to raise their interest rates, right? But Canada, we're not really playing that game. Canada decided to pause. And so we have to take a look at what's happening with the Canadian dollar to United States dollar. A year ago, we were sitting at 80 cents. Now we're sitting at 73 cents. And a lot of people think 7 cents is not such a big deal. It is a big deal. It's a very big deal. Also, if we look right here, we're going to make some notes about this. Actually, I'm going to write it down for us, and then we're going to check it together. So if you look right here in 2020, it says 1742. I'm writing it down. Then we're going to look at it together. And up here where we are right now, we're sitting around 2000, right? Can you see those two numbers? Okay. Also, Canada's money supply. So I'm going to write M2, and then I'm going to share my screen in a second. 2019, if we look at 2019, we are sitting about 1.7, 2.4, and 1.7. So I wrote them down. This is the money supply that you have to check. We're checking the GDP, right, was the other one. And we're also checking our 72 cents from 80 cents, okay? We're going to check these three things together. All right, so now that you know what my numbers, let me share my screen with you so that we can work on some stuff together, okay? So these were the numbers. So if we look at the money supply, which is right here, M2 money supply, this is very, very important numbers. So if you look at the numbers, according to M2, now there's M1 supply, there's all different types of supplies. I'm going to be showing you my calculator, right? So if we take 1.7 times 1.5, we come to 2.55. So what that means is the difference right here between these two, 1.7 and 2.4, is just around 50%. Okay. So the money supply went up 50% on M2 money supply. Now let's try and figure out right now this one right here, which is what? Our GDP, which is how big the economic engine of our country is. If we take 1742 and then multiply that by 1.5, what do we come with? We come up to 2613. So we're short, right? The GDP has not adjusted up 50%. It has not. And so notice when the money supply goes up 50%, we should, in theory, be able to see the GDP go up 50%, but it did not. It did not. It went up like 30%, not 50%. And the reason is because we can make the 50%, we can make that really, really quickly, you guys. That 50% can happen really, really quick. They could just do that in an email, but it takes time for this to soak through. So what I like to think about when I'm thinking about this, think of like a tree, you know, and then the ground. And when you go and take water now and put water up here, how long does it take for the water to get down to all the roots that are below? Well, it takes time for it to soak through the ground and get to the roots, right? So you could print this money here, 50% more money from 1.7 to 2.4 trillion. You could do that really, really quickly by dumping all the water on the surface of the tree, but it's going to take time for it to soak through to the roots. And this is why the GDP is not reflecting that right now. But we have more problems that are coming from this right now. And this is the 72 cents to 80 cents. Do you remember I showed you the chart that had Canadian dollars to USD? So when we had Canadian dollars to USD, when we had that, the chart looked like this. It started off at 80 cents and then went down to 72 cents. So most people would tell me, well, David, that's nothing. That's 8 cents. Who cares about 8 cents? What does 8 cents change anything? And my question to you is, how does it not change anything? So Canada imports $750 billion worth of stuff, and the majority of it is coming from the United States. So if you add your 7 or 8%, it's nothing. That would add around $50 billion to inflation. So your $750 billion worth of stuff that we brought in last year is now going to be $800 billion for the same pile of stuff. So that's got to be divided up. We got to take the $50 billion and divide it up by every bag of rice, every TV that you buy, every computer that you buy, every single thing you buy has to go up by this. And so this is the irony. When I was telling you about the United States dollar and the Canadian dollar, when I was talking to you about those two, we have the same information, high employment, right? And Canada has high employment as well. We have high inflation, right? What does Canada have? High inflation as well. And we decided to pause, which is, some people are happy about it. The United States is hiking the rates. Of course, we both have the information that we need to hike the rates, but Canada decided to pause. And so in Canada, we typically have about $1 million price tag of homes where I am. This is $1 million. Let's say in the United States, let's use the same number, okay? $1 million. In some of the big cities, it's that way, right? If it is $1 million, just let's say that it is. When you pause the rates in Canada, we did not hike it by 0.25%. It would save about $150 per month, okay? So now, by doing this move, people are celebrating, yay! I save $150 a month. And over on the US side, they just raised the rates today, $150 more they're going to have to eat on their mortgage. Okay, so, but did you just see how I was talking about all the goods that are coming in? So we just saved $150. So people are cheering. But now your cost of living, like we just explained up here, the cost is up now $50 billion. And that has to get divided among all the food and stuff that you have. So now it's going to cost you an extra $150 here. But in the United States, guess what? Their cost of living will remain the same. Now, of course, there's a million variables to this, right? So at the end of the day, no matter what, the US has chose to hike rates and hike the cost of their home by $150, but their cost of living is the same. In Canada, we decided to pause our rates. So your cost is going up $0 on your home. That's $1 million, but your cost of living is going up. Either way, see these two? We're both going up $150. Either way, no matter how you slice it. So it's interesting to go through the Canadian numbers, but we always have these problems is that the majority of people that we talk to, and we sell homes all over the Greater Toronto area. We sell homes faster for more money and less hassle. If you need anything, go to sellhigher.ca, or you can send me a private message on here. But we sell properties all the time, and people always want that quick, instant answer, right? We live in a headline society where they only want to see the one sentence, the clickbaity sentence. But if anything, I hope that I'm inspiring you to be curious and ask questions, because we have to dig into the reasons why things are happening. And it's very, very, very hard for us to be able to tell what's going to happen next week, but it's very easy to tell what's happening with the trends. Let me show you this. It's very easy when you zoom in and you see this happening. You're like, what's happening next week? I don't know. This day, I don't know. But it's very easy to tell the trend. So when you're asking the majority of people, we don't know if the next day it's going to go down a little bit or up a little bit, like 0.1%, but this trend is pretty easy to spot. And that's what I want you to catch on to. So there's a rule, 1% for your mortgage rate equals 10% of your home. Okay, so if mortgage rates go up 1%, your home price drops 10. That's the mortgage's rule. And so if you have $1 million home and a 1% rate happens, then your home goes down to $900,000. Now, this isn't the same for all products. This is just a general rule. So commercial is going to be different than residential, condos, and all different sizes and locations. This is just a general rule for underwriting within the mortgage industry. So just pay attention to this. So when we see interest rates, if you noticed me last year, once they started announcing that they're going to raise rates, I was telling people you should be selling your homes. And as that's gone on for the year, I don't understand all these agents out there who are saying best time to buy, best time to buy, best time to buy. And people are losing money in Toronto, Vancouver, New York, San Francisco, Chicago, $10,000 a week. That's shocking. You know how long it takes people to save up $10,000? Can you believe that? So though we can't tell exactly, and I would have thought Canada would have raised rates, but I was right the other 7 times that they raised rates. But this time I'm surprised that they didn't, because they had all the ammunition that they needed to do so. If we look at this, it's very, very hard to always be able to call them exactly what they're doing, these little moves, but that big swing that's underneath, that big swing, we can tell exactly what's going to happen to home prices. So we knew that they were going to fall. They're probably going to fall quite a bit more this year. Now we're going to have some rescue maybe if the economy goes off of a cliff and they drop rates. But the overall, remember, you're in a bathtub, hot water, cold water. Cold water is the interest rates. That hot water, man, is the economy bubbling. So you have to try and figure out, is the water warm, too hot, or too cold? Because you're watching them turn on those hot spigots and the cold spigots. So that's why I want you to pay attention to this stuff. You guys stick with me over the next 2 years. I'll help you a lot through the way. The next 2 years is going to dictate the next 2 decades of your life. I promise. Guys, if you want to sell your properties, go to sellhigher.ca. That's where I can help you. We sell properties all over the Greater Toronto area. We have courses available for you too, investment calculators. Anyway, we'll do our best to help you through this mess, you guys. I wish you the very best. Hope you have a great night. Please consider subscribing and tell your friends about us. Have a great night.